The first presentation will be in English language, and the speaker is Peter Mulroy. For 7 years, he's the Secretary General of the FCI, which is the Factor Chain International. He also was working for 14 years for CIT in Atlanta, in the US, as Managing Director and International Regional Manager. The funny thing is that poor Peter is doing the presentation in the United States. So currently, it is 4 o'clock in the morning in the US. And Peter, we are really, really happy that nevertheless you are giving us your presentation. That's really great. Peter will talk about the international factoring, the past, the present, and also ideas about the future. Ladies and gentlemen, we proudly present Peter Mulroy.
Thank you very much. I first just want to make sure you can hear me correctly.
Yes.
Yes, thank you. Well, ladies and gentlemen, good morning. I'm delighted to be here. I first want to thank Arnulf and his colleagues, Danielle, Karen, Roscoe, and all the others who who I've worked with over the years, and congratulate the FCOM team for this 20th anniversary. I would like to share with you my presentation. If you just give me 1 second. Let's see. And please just tell me if you see it.
It works?
It works.
Oh, wonderful. Okay, well, the marvel of technology. Yes, this is correct. I am contacting you today from the United States. Unfortunately, I had a death in the family, so I'm here in the U.S. Attending the funeral this week. But I'm really delighted to be here, and I am just going to speak very briefly about, as was mentioned, this, let's say, what the title, Phenomenal Growth Story. Kind of a look back at 20 years when FCOM was formed, kind of look at where we are today, and also where we are heading tomorrow. I want to start out with this slide, which just honors FCOM for its membership of FCI since 2006, 14 years. And these are just some of the names of the members of FCI who are supported by FCOM. And so we just want to, again, I want to thank you again, FCOM, and congratulate you. I know, I remember seeing in your website, you have something like 40 financial institutions supporting in 11 countries. So I wish you continued success and hopefully doing this another 20 years from now. I'm going to just talk very briefly about the history of factoring. I think most of you know this. The modern era of factoring started in 1814 with the start of a predecessor company of mine, CIT, back by a great grandfather of the founder, and that's hence they state the modern era of factoring began in the United States. Basically, it went through numerous iterations from 1814 to today. But there are two significant dates, 1925, when the New York Supreme Court basically elevated what we know today as modern day factoring, where you're providing financing, a collection service, and of course the purchase assignment of receivable, and no longer acting in a sense as a trading company, actually purchasing the goods, owning and holding the goods. So it was a departure. And then the second evolution was the formation in the U.S. of the UCC, the Uniform Commercial Code, which basically created the first global receivables registry. Factoring then migrated back to Europe in 1959. The very first invoice was factored by a joint venture of CIT in February 1960. And basically, Factors Chain and IFG Group would be formed around the same time in 1964. FCI actually started in Stockholm, but was later moved and formally founded in 1968 in Amsterdam. And the IFG was formed in 1964 in Zurich. It grew significantly from in 1968 when FCI was formally formed. We had 12 members in 15 members in 12 countries. And that now, as you know, we're in actually 94 countries and nearly 400 members. So let me go to the just some of the other important date, which is 2000, which is the date that FCOM was actually formed. As I said, we have actually 386 members as of today. We are in 6 regions. You can see here in every region we have a regional manager. So for the Americas, it's in Argentina. For Africa, it's in Cairo. For Central Eastern Europe, Middle East, it is in Istanbul. Northeast Asia in Shanghai, and South and Southeast Asia in Hong Kong. Now, this talks a little bit about the growth of membership in FCI. You can see here that in 1999, so the year before FCOM was formed, 21 years ago now, we had a little over 100 members. And you could see the trajectory of growth in membership in FCI. Now, it's interesting, if you look at where that growth is coming from, you can see that the 2 largest, let's say, beneficiaries is in Eastern Europe, Central and Eastern Europe, so which that light blue, saw the greatest growth. And the second largest region, East Asia. But also to mention, Middle East Africa has grown extremely well, as has South Asia. And the most recent is Bangladesh. FCI have been working together with the central bank for the last 10 years to develop a factoring policy. They announced it in June. And so we have gone from 0 to 10 members just in the course of the last 12 months. So you can see the progression that we're making, especially in the emerging countries. The same story is told regarding the international volume, the global volume of factoring. You can see here it's a similar trajectory, 9% compounded growth rate. Going back to a year before FCOM was formed, it was a little over 500 billion euros, and today that figure stands at nearly 3 trillion euros, basically a 6-fold increase. That's phenomenal growth, and there's 3 reasons for that growth. The first is Europe. Europe accounts for, you'll see in a second, 2/3 of the global volume. And it has really been one of the drivers, especially since the Great Recession, 08-09. Europe has been growing at the fastest pace of any region. The second is Asia, really China. If you go back to 1999, there was just a few invoices factored. And today, China is the largest factoring market in the world, over 400 billion euros. And the third is international. You can see in the dark blue, that's international volume going back to 1999. It accounted for 3% of global volume, 3%. Today, that figure stands at almost 20%. Okay, so I want to just show this slide, which just shows the same picture of factoring, but this is in US dollars. In comparison to total open account merchandise trade and LCs. And you can just go back to 2000 when FCOM was created. You could see how factoring has grown just extremely fast during this period. As shown in the previous slide, And in comparison to LCs, it's also grown, but not nearly to the extent. But one noticeable difference, LCs, of course, are predominantly international cross-border, where 80%, as I mentioned, of factoring volume is domestic. And I can say, too, that domestic factoring over the last 4 years, since 2015, actually has been growing faster than international. It's the first time, if you look back previous 20 years, that domestic is growing faster than international. But the most important story here is the upside potential. You can see $20 trillion in open account trade. So the huge opportunity, of course, is in receivable finance. Now, the last slide I want to show you regarding volume is just an estimate. Of course, we know what the factoring figures are based on our collection of data, FCI's collection. In dollar terms, 3.27 trillion. If you compare that to, for example, reverse factoring, which is estimated at approximately 750 billion, I think that's a conservative estimate. Asset-based lending, reported by the CFNet in SFNet, excuse me, the old CFA in the United States, estimates around 420 billion. And we estimate AR securitizations at a minimum 1 trillion. If you add those together, that's a $5 trillion market. A $5 trillion, that's 6% of global GDP in this open account space. And the interesting story here is the future. If we continue to see factoring growing at approximately 9% that we've seen in the last 20 years, and we know reverse factoring is growing at that pace, if not more, we can easily estimate that this market is going to exceed $10 trillion by 2030. Now, if you look at the product and segments, what's interesting is the dark blue. 42% of total global factoring volume of that nearly 3 trillion euros is non-recourse factoring, so with some form of credit protection. And the interesting story there is that figure continues to grow as a percentage. Why is that? Number one, companies and financial institutions are benefited from a capital treatment, a Basel treatment standpoint, when purchasing receivables on a non-recourse basis and financing and funding those sellers, those exporters. The other is, of course, and most international business is conducted as well on a non-recourse basis, and international has grown exponentially over the years. And then the last is window dressing. Being able to remove those receivables from the balance sheet in substitute of cash. Obviously, for a publicly traded company, it has a positive ratings impact. The other is invoice discounting, 23%, recourse factoring, 17%, and then 18% other. The other is the segments is what percentage is international compared to domestic, and you can see here, 81% domestic, 19% international. And as I mentioned before, the international factoring volume has been growing the fastest, one of the three drivers over the last 20 years. But we have seen a marketable slowdown in the course, really since 2015. And why is that? Certainly there was a slowdown in China. There was, I don't want to say a recession, of course, but certainly a slowdown. It resulted in numerous factoring frauds in 2015 and 2016. So a significant case in court load in the lower courts in China, factoring court cases, bankruptcies, and frauds, as I mentioned. And then second, of course, the trade war. That has also had a very decelerating impact on the growth of cross-border factoring. Look at domestic, 81%. And as I said to you before, domestic has done very well, especially in the last 4 years. Okay. I want to turn now to where the pandemic year, 2020, talk a little bit about what's happening in the factoring space. But we have to first look at GDP. And we can see here that, of course, first, this data is from the second quarter, 2020. But you can see South Africa reported a minus 51% decrease in GDP, the largest, most hit country in the world, bar none. Granted, they probably had one of the most starkest closures of any country around the world very early on, I believe, starting in the end of March. The second is the United States. You can see 33%, and et cetera. You can see UK on there, France, et cetera. The only country showing a positive figure is China. And that is because they suffered more in the first quarter. But second quarter, they posted a 3% increase in their GDP. The second, observation is the significant number of frauds, so fraudulent transactions. And you can see here, these are some of them. The most probably well-known name is Hin Leong, a trading company in Singapore that basically manipulated their financial statements and sales and invoices. Another is Agritrade, OnTop, Zenrock, all this year in 2020. But the amounts far exceed $4 billion US dollars. Another one, of course, in Germany, Wirecard. I don't need to tell you about that one. There's a company called Luckin Coffee in China that's actually traded in I believe it was in the NASDAQ stock exchange. That also had a huge fraud there. So fraud is on the rise. It's a great concern, and especially for the factoring industry. We haven't seen many frauds hit the traditional factoring space. I did hear of one larger fraud that hit the reverse factoring space in the Middle East, in the United Arab Emirates, a pharmaceutical company. And I heard of a small retailer in France, and let's say two other smaller companies, non-investment rated companies. So the truth is, and this is of course always a fear on reverse factoring when you have such a concentrated risk of payables on the balance sheet of the anchor buyer, and you're taking a significant chunk of that payables risk. This is obviously a great concern, and one we're keeping a very close watch of. But I can say, though, from the traditional factoring sector, that I have not heard of, and I've been speaking with numerous members of FCI around the world, I have not heard to the degree of any type of fraudulent loss at this stage. The other is bankruptcies, so traditional bankruptcies due to financial stress. You've heard some of the names. I can tell you the second quarter, especially in the United States, it seemed like there was a major retail bankruptcy once a week. The largest being JCPenney's, one of the largest department stores in the United States, that hit in June. Brooks Brothers, Hertz rental car, Avianca, which is the second largest airline, also traded in I think, the New York Stock Exchange. All these had a significant hit on our members, and especially the U.S. members, which has been a very challenging year. But what's concerning is the predictions. This is a prediction by Atradius. They came out with their insolvencies reports, and they estimate that bankruptcies will increase in 2021 by 33%. You can see here in this slide in the dark red. Who are these markets that they expect it to be extremely severe? Look at the United States, almost 60% increase, which is quite shocking, considering the fact that this past year we have seen really one of the hardest years in terms of retail bankruptcy. I just read in the newspaper this morning of another bankruptcy, a restaurant chain, famous restaurant chain here. So it just doesn't stop. And of course, the great concern is the fact that the liquidity from all of these government programs, which I'll talk about in a second, is drying up. But you can see Brazil, Ireland, Portugal, UK, Netherlands, Spain, China, Singapore. I mean, these are all over the 33%. Germany is there, and I can't see it right off the top of my screen. It's low, actually, but it does show a plus 13% increase, it appears. Anyway, I think this report tells me that we are certainly in for tough times in the coming days ahead, coming months ahead. Okay, let me, yeah. So this is just a brief overview of some of these government programs that have supported the economy, small to medium-sized enterprises. And we all know that governments in Europe, Germany being a leader, have stepped in to provide what we call credit insurance shields, so backstop measures to support trade credit insurance for small to medium-sized enterprises in Germany. And I think these programs have helped. They've supported, especially the trickle-down effect, two factors who ultimately provide liquidity to SMEs. And we know from a report that we did that's approximately 70% of all clients factored in the EU, for example, are SMEs. The French government announced a new scheme to support SMEs as well. It's interesting because this program was fashioned basically acting as a purchase order mechanism. So with a purchase order, a SME can get funding by a factor. So it is targeting the factoring community, which is so interesting. There's a similar program in Italy, but I hear that it's not as, let's say, effective, and certainly not as effective in the factoring space. And the other, of course, the largest is the PPP, the Paycheck Protection Program, which was launched in April of this year as part of the CARES Act that was passed by Congress, providing COVID relief. And it has been very effective. Numerous SMEs, even some, let's say, larger corporations have benefited from the PPP. And what's interesting about the PPP is that it is a loan program, but if you can provide evidence showing that the program has supported keeping employees from losing their jobs, then that loan could then be turned into an actual gift, meaning you do not have to repay it. So certainly a very motivating program. Again, the problem is that the program is now running out of funds. Now, I want to talk a little bit about what we're seeing, actual figures in the industry. And the first, of course, is just our own. We have our platform, Edifactoring, which is used by approximately half to about 200 of our correspondents to do cross-border factoring with the onboarding of a foreign correspondent for the purpose of collection, protection of the receivables, dilution management, et cetera. And we saw a marked decline of 25% in transactional volume through I think it's August, if I'm not mistaken, August of 2020. This slide, the green is as of June, and you can see here South and Southeast Asia and Northeast Asia have been the two hardest hit regions in terms of cross-border volume just in the Edifactoring platform. And I always say Edifactoring is a great predictor of where the trouble spots are, where we're seeing it, and also growth opportunities. Of course, in this case, all of them are negative, but these two regions are particularly hard hit. So I mentioned 25% decline in our EDI factoring volume. The European Union Federation, the EUF, reported a minus 6% decline. And I have to say, this really surprised me. And I have to congratulate the German industry. Germany, together with the Netherlands and Poland, were the three most successful markets in the EU in the first half of 2020. I can't remember the exact percentage, but I believe it was approximately 2% growth in Germany, for example. The Netherlands had the most growth, I think nearly 5%, which is just astounding considering that the economies were basically shut down in the months of April and May. So an astounding, it just surprised me. And I talked to a number of European factors, and they're telling me, yes, in general, negative, figures for the first half. but they're really aiming to have a break-even year. So no loss of volume for 2020. The next is the asset-based lending industry, which is predominantly receivables, as we know, and they reported a minus 25% drop in volume as well in the first half of 2020. And the second is Swift. Swift reports in their report for the first half of 2020 a 15% decline in LCs and other trade products. Now, I had written a paper back in May. This paper really I wanted to look at past recessionary periods to kind of get an indication what happened to the factoring industry during these periods, and the two biggest being the Great Depression and the Great Recession. Now, granted, the factoring industry was really just a U.S. industry at that time when the stock market crash hit in 1929. But in the article, I talk about the effects of this and what happened. There was a huge migration from unsecured lending or traditional loans to secured finance, and factoring being one of the biggest accelerants in the finance industry in the United States. I can tell you my previous company that was actually acquired by CIT was SunTrust Bank's factoring division. And that company was started in, I think it was 1939. CIT itself really increased its factoring through acquisitions in 1930, 31, 32. So you saw this major activity of either mergers and acquisitions or companies like SunTrust that was the first bank in the world to start factoring. Unemployment peaked at around 25% in 1933. But we have factoring data in the U.S. market, and you can see from 1935 to 1948, the industry grew at an unprecedented 13% compounded annual growth rate, a full fourfold increase in the factoring industry during that period. Now look at the Great Recession in 08-09. You could see here that, and we know what happened, all of us experienced it. In fact, factoring volumes declined by a minus 3% in 2009, generating approximately $1.3 trillion that year. Unemployment was at a peak of around 10%. But a decade later, what did we see? A growth of the factoring industry from 1.3 trillion to 3 trillion euros, approximately. More than a twofold increase. And again, continuing 9% compounded annual growth rate. Just a phenomenal success story. We did see in 08-09, I have to say, the reverse factoring, what they call supply chain finance in the United States, was a hit in the sense that there was a concentration in the auto sector, and you know what was happening in the auto sector during those years, as is we're seeing the last 12 months in the auto sector. The United States government had to bail out, if I recall, General Motors and Chrysler. There was a number of mergers afterwards in the auto sector, but in the auto retail parts sector, there were a number of companies that were using supply chain finance, and those programs were cut back considerably or eliminated in its entirety. So the reverse factoring was affected, and I was expecting as well a similar impact, again, because of what we're seeing in the auto sector. And I know Germany has a very large factoring, let's say, concentration in the auto sector. So, in part of that article as well, I did list some predictions about what I thought could happen. And the first was I just talked about, that we're going to see a rise in bankruptcies. We're starting to see it in the U.S., but I think we can say definitively that we have seen a huge increase in bankruptcies and frauds, and that continues unabated, as I mentioned before. What does that mean for the factoring industry? Well, it certainly means that traditional banks are going to basically continue to be very conservative. They're going to continue to pull lines, especially unsecured lines and other forms of, let's say, traditional bank lending. And you're going to see a significant shift towards factoring, asset-based lending, and other secured finance products. I'm hearing from our members globally that they're seeing a huge spike in demand and interest in in factoring in general. And why is that? Well, some of them are inquiring about it because they view having alternative sources of funding, so not just from their traditional source, as something of being imperative to survive this period. So I'm hearing from many of my colleagues that they're seeing a number of new opportunities knocking at their door. The other is the rise of fintechs, and we continue to see a huge interest in fintechs. And of course, we know from the news and media that digitalization and of course, I mean, the fact that we're talking, I'm here in the United States talking to you on this Teams call is just an indication of where we are and how technology has helped drive us to this point. And I believe that fintechs are going to be, a huge, let's say, they're going to propel. But in the short term, what I predict, though, is that you're going to see a number of them go out of business because of this issue of increase in bankruptcies and fraud and increased challenges during this time when fear increases to raise a significant capital, enough capital to basically support their business. And the other is reverse factoring. I was stating in this that I thought that we would see something that we saw in 0809, this pullback of this large concentration risks. Granted, these are investment rated companies, but as you know, in the last 10 years, what we've seen is a significant increase in non-investment rated companies. So I did talk to one or two banks in the United States, for example, to find out what was happening in the space. And I was really shocked. What I was expecting to hear was that they pulled lines, that they've been more conservative, and it's just the opposite. And why is that? Because what you've seen in the U.S. market is a significant concentration. All of these retailers in the auto parts sector, for example, AutoZone, O'Reilly Parts, just to name a few, have all consolidated in the last 10 years. So they have a much stronger balance sheet. And who is driving the growth in retail? It's Walmart's, it's Amazon's, it's Costco's, and other very large e-retailers or traditional retailers, but the big box ones. And their programs are growing double digit. So what's interesting is that some of these sectors we're seeing significant growth, and I did not predict that. Okay, so and in fact, one of the people that I spoke to said, these big box retailers, these big e-retailers, they've really saving retail, which is hard to fathom because, of course, we know that they have had such a negative effect on the traditional retail space. But in essence, though, because of their strong balance sheets in this financial storm that we're in, it's had a very positive effect. But I have also heard that non-investment rated companies have been hit. And I mentioned a few that have filed bankruptcy. And what you're seeing, I believe, and I'm hearing this from some IT companies and others, that you're seeing a strategic basically shift away from funding of non-investment rated companies under these large reverse factoring programs. Okay, so I'm going to go to the next slide. And this is the last one. And I just want to say, I just see this crisis opportunity, as the Chinese say. This is a significant opportunity for our industry. It's proven historically that the factoring industry does extremely well during financial crises and thereafter. And we're seeing it. Yes, short-term pain, a number of retail bankruptcies, a number of hits. I hear it in Europe as well, just not as significantly as the US. In China, I'm hearing that there's a huge rise in frauds domestically, but I have not heard that translated yet in terms of factoring losses. From the standpoint of how to avoid fraud, we always, my chairman, Patrick de Villepin, and I call this the need to be going back to basics and focusing on sustainable risk profiles, our core products. For example, not launching new non-notification, so non-debtor notification programs, just the opposite. There should be more notification. There should be more invoice verification. There should be more verification of the transaction to ensure that fraud doesn't happen. a greater enhancement, of course, of risk profiles, which is, of course, happening everywhere, and implementation of strong operational controls. And last, but not least, is investment in technology. And this gets to FCOM, of course, as a technology leader in the factoring space. What's so interesting is that, I'm hearing that in 2020, there has been actually a decline in technology investment. Yet you're hearing everywhere, left, right, and center, that there is a significant increase in the need, digitalization, artificial intelligence, using data, big data to help understand and drive knowledge relating to dilution risk, relating to fraud risk, and blockchain as a means by which to control and verify transactions and increase security. This is all coming. It's just not coming now. I had a call today, ironically, or yesterday, with a smaller IT company, and they were telling me that they're having a great year. But they're having a great year because their price points are probably the lowest in the industry. So there is still opportunity. I just think that from a budget standpoint, in 2020, it's been a very tough year. And I think everybody has been adversely affected. So it's understandable. What I am hearing, and during our FCI annual meeting last week, 2 weeks ago, we did a survey of all the attendees, 500, and basically asked them if they were going to invest in technology, increase their investment. It was something like 97% said yes. So if that is an indication, I think for IT companies like FCOM and others, it's going to be a great year in 2021. So ladies and gentlemen, that ends my presentation. Again, I want to thank Arnulf and all of his team, and I wish you all a great day. I will stay around for questions, and again, thank you for having me, and I wish you a wonderful conference. And again, congratulations to FCOM for 20 years. Auf Wiedersehen.
Thank you, Peter. Thank you very much for getting up that early in the morning to give us this great overview. Thank you.